Hedge funds are often seen as the pinnacle of finance, and honestly, unlike at investment banks and some PE firms where there can be some deadweight and unintelligent people, you really need to be smart, competent, and hardworking if you want to work and stay employed at a hedge fund. And you're going to understand why this is the case as we go through this video, where I'll be discussing the good, the bad, and the ugly aspects of working at a hedge fund. But before getting started, if like me, you're fascinated by the world of investing, you may want to check out the Applied Value Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program teaches you how to apply the principles of value investing with the sophistication of an institutional investor, and it's taught by Wharton professors and keynote speakers from real investors, including Oaktree's founder, Howard Marks, who is one of the most famous investors in the world. Through this 8-week-long program, you'll learn about the core concepts behind value investing, such as market efficiency, intrinsic value, process-driven value investing, and a whole lot more. And you'll also gain access to an exclusive global network with access to special in-person networking events. And so whether you're an individual investor or a student trying to break into a hedge fund, this program will give you the fundamental knowledge you need to invest like the father of value investing, Warren Buffett. And if any of this is of interest to you, be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything I just discussed in this video's description. All right, now with that said, let's go into the good aspects of working at a hedge fund. The first point is lots of ownership. At a hedge fund, you own your P&L. And so even if you are the most junior analyst supporting another analyst, and of course, if you're a portfolio manager, your work directly results in either profit or loss. This means that you have a super direct and measurable impact on how the fund performs, which in contrast to, let's say, private equity or venture capital, where investment horizons are really long and the performance of your investments are often in the hands of the ones operating the companies that you invest in rather than in your own hands. This is a huge difference between hedge funds and other buy-side industries. I really do think this is an aspect of hedge funds that investors truly enjoy, because in the vast majority of jobs that are out there in the world, you don't always have a clear-cut understanding of the impact you're making, but at a hedge fund, it's extremely clear, which can be really refreshing. This leads to the second good aspect, which is a meritocratic and no BS culture. Hedge funds are the most meritocratic organizations in the world. If you generate ideas that make money, you'll gain more and more responsibility, which in turn leads to more compensation, often in the millions of dollars. There's also very little bureaucracy, unlike pretty much every other type of company in the world, whether it's private equity, banking, or corporate. And this is because markets move so quickly and there's so much news flow and events happening all the time that you and your team really need to be able to analyze data and information and make decisions really quickly and accurately, and as accurately as possible. Otherwise, you could potentially lose millions of dollars. This also means that unlike in jobs like in banking, where you might spend endless hours arranging logos and making things look pretty on PowerPoint, at hedge funds, you don't need to worry about that at all, because formatting really is not important. All you really care about is getting the right answer as quickly as humanly possible. Third, hedge funds offer one of the most intellectually stimulating and challenging jobs in the world. Now, this could be a bad thing if you're just trying to take it easy in life, but most people at hedge funds self-select themselves into the industry because they first love finance, and then second, love the constant challenge of learning about businesses, industries, and markets, and making high-stakes bets on their convictions. Whether you're analyzing a company's financials, interpreting macroeconomic trends, or trying to read between the lines and dissect what management is really saying in an earnings call, you're constantly thinking critically and adapting quickly. And so if you thrive on continuous learning and enjoy high-stakes decision-making, where your ideas are tested daily, hedge funds really offer an unparalleled opportunity for you to challenge yourself and really grow. All right, next up, let's go into the bad aspects of hedge funds. First, you have very limited exit opportunities. You build a very niche skill as a hedge fund investor. And so as you progress in your career, it's not like you have operational experience or have built something. So if you decide you want to leave the industry, you don't have a ton of options. And for the most part, usually investors just lateral to other hedge funds. Sometimes they'll go corporate or to private equity, start their own funds, or maybe even start their own businesses. Of course, with all this said, hedge funds are the ultimate exit opportunity in finance. And so most hedge fund investors really just view investing as their long-term career anyway, so that's why this is in the bad section and not the ugly section. What I do think is important to note though is that working at a hedge fund is very, very stressful and you can easily burn out, as we'll discuss later on. And if you do, you just don't have as many options as you would maybe in investment banking or consulting to leave to another industry that you might be actually really interested in. So that's why this is kind of a bad aspect of hedge funds. The second bad aspect is that the job is much more independent and not a very social job, which depending on the person can be a good or bad thing. Now, while you do work with your portfolio manager and sometimes collaborate with other investors to bounce ideas off of each other, for the most part, you are driving your own analyses and figuring out a lot of things on your own. So you need to be very independent. And so if you're looking to kind of interact with others at work, which most people kind of do, then hedge funds may not be for you. Next, third on the list is the instability with compensation because everything is based on your performance for the year. Now, while you often hear about right tail outcomes and how hedge fund investors make tons and tons of money, my friends at hedge funds tell me that in reality, there are way more people who get zero or low bonuses, which means you could work extremely hard at a stressful, high pressure job for an entire year and only get a relatively low salary of 100 to 150,000, while your peers at other funds can be making millions if they're performing well. Or your friends in banking or private equity are enjoying stable annual compensation that pays at minimum $300,000 or more. As a result, for those who value consistency and financial predictability, this volatility in pay can be a significant downside. And that's actually why a lot of my friends in private equity decide to stay in the industry rather than work at a hedge fund. Now, before moving on, I really quickly wanted to let you know that I'm working on a free series of 10 emails that will consist of my best tips for breaking into investment banking. I'll be including everything I've learned and gained from being the JP Morgan UC Berkeley recruiting captain for 2 years and coaching hundreds of students who have gone into all of the top banks. So if you're interested, check this video's description to sign up. All right, let's now go into what you're probably most interested in, which are the ugly aspects of hedge funds. The first is high rates of burnout due to the high pressure and long hours. While there are many stressful jobs in the world, at hedge funds, your work directly translates to trades that can lose hundreds of thousands to millions of dollars, sometimes in a matter of days or at worst, a matter of hours. I really don't know how they do it. Now, of course, hedge funds always have risk controls, but in the market, things can always turn sour very, very quickly and unexpectedly. And so especially early on in your career, you can feel like you're always on edge because if you don't perform and lose money, you can get fired at any point. In addition, things never really turn off and you can feel like you have to be on 24/7 since global news flow means that there's an endless fire hose of information from all parts of the world that can affect your positions at any moment. So that can all be very, very nerve-wracking. The final point that leads to burnout is that when the markets are open, you are wired and super on top of everything because there's so much constant information coming your way, especially during earnings season if that matters to you. And then once they close around, let's say 4:30 p.m. in New York, that's when you have to do more work on new ideas and do additional research while you may already be exhausted from the day. All of this leads to high pressure, long hours, and lots of investors getting burnt out, especially considering it's hard to fully take vacation with everything turned off at any point in the year. The second ugly aspect of hedge funds is the ethical gray areas that can arise in the pursuit of profits. Hedge funds operate in a high-stakes environment where the pressure to outperform can sometimes lead to questionable decision-making. While most funds follow the rules, the temptation to stretch ethical boundaries can be strong, particularly in areas like insider trading or market manipulation. There are tons of high-profile insider trading scandals that pop up all the time, and these highlight how some funds have crossed legal or ethical lines in their pursuit of alpha. Even if you yourself personally don't engage in unethical behavior, you might find yourself in situations where the practices of your colleagues or the industry as a whole might make you feel a little bit uncomfortable, and that constant tension can weigh heavily on your conscience, especially if you're someone who values integrity and transparency in your work. And so while not all hedge funds operate this way, and I do think the media really stretches it out of proportion, the potential for moral dilemmas is an ever-present reality at hedge funds. The last but not least ugly aspect is that at the end of the day, you're not really building anything meaningful. Ultimately, hedge fund investors are just simply moving numbers around all day. They're not building anything innovative in terms of products or services that change the world for the better. And this is something that can really eat at you over time if you're looking for a truly fulfilling life. Of course, you often self-select into working in this industry because you love investing and finance and money. And hedge funds do invest on behalf of many large institutions such as pension funds, universities, and charities, which means that your work can directly support important causes. But with that said, there is a large disconnect between your day-to-day work in financial models and in Excel and any kind of tangible impact that you actually really want, which can lead to a lot of existential questions about whether your contributions really matter to society in the grander scheme of things. Alright, so that covers the good, the bad, and the ugly aspects of working at a hedge fund. Let me know what you guys thought in the comments below, and if you want me to cover any other aspects about hedge funds in particular. In the next screen, you're going to see a video about what hedge funds are all about and an overview of the industry. Feel free to check that out if interested. With that said, thank you guys all so much for watching this video and hope to catch you in the next one.